Hello and welcome to this webinar. My name is Stanislav Bernikov and I'm a full-time professional trader with more than 10 years of experience. I will be a host in this webinar where I'm going to share with you some interesting information concerning trading. If you have any questions, feel free to leave them below this video. Enjoy! Hello and welcome to this webinar. The topic of this webinar is how to trade breakouts, or in other words, how to buy high and sell even higher. Such type of trading occurs when you buy high and sell higher, or vice versa, sell low and buy back lower. First of all, let me say a few words about myself. I've been trading for over 11 years now. I was trading in various markets such as futures, including stock indices, commodities, financial and option markets as well. My favorite market now is Forex because it allows to capture really good opportunities within a day or a week, employing short-term trading style. And breakout momentum trading is one of my favorite strategies that I use on a weekly basis. I suggest you to listen to the information and make notes if necessary. If you have any questions, you can leave your questions just below this video and I'll do my best to answer all of your questions. Before we start, let's take a quick look at the disclaimer. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. Risk of trading in financial markets can be substantial, and you will have full responsibility for any of your trading decisions. Past performance is not a guarantee of future results, so please remember about risks and trade responsibly. First, let's remember what is a breakout momentum strategy. Breakout momentum trade occurs when you buy high and sell even higher, or vice versa, when you sell low and buy back even lower. So when you trade the breakout, you want to capitalize on rapid price action and build destination trade around certain level. You want to trade the breakout of consolidation area, or you may trade within a trading range, it doesn't matter. First, you identify a certain level that can be called go, no go level. Price either breaks this level and goes or not. Let's talk now about the most common setup that you are about to meet in the marketplace. It is very easy to trade, yet it is not very easy to recognize because market will not show you such setups too frequently. Here we are talking about trading breakouts at the edge of the price action or at the top of the price action in this particular case. When you see rising highs, rising lows with decreasing volatility, you see that market consolidates around extremes, the volatility is going down and eventually market is very calm. So you can trade the breakout, you can place a buy stop order here. You can go with the price. Now let's remember the clues for support or resistance. By support or resistance here I don't mean any horizontal levels or areas like the majority of traders do. By support I mean consistent absorption of supply on the market in the form of dynamic action. Some traders try to identify support using volumes or open interest or order flow or some other complicated techniques. As for me, I always have been employing simple techniques which don't require anything really complicated except the price chart, which is not complicated at all. And there are two major observations that can help you identify support or resistance. First of all, it is what I call right-handed skewing. If you can build 90 degrees angle between impulse and the correction, you may see what I call elongation. It may look like consolidation area at the top of the price action or at the edge of the price action when market is unable to generate really big correctional move. So when market is unable to get back to previous trading range quickly, which is visible in the form of relatively small correction, we have the assumption that supply in this market is being absorbed. And also real support is dynamic rather than static. if you see the market reacting on a single level, for example, like I'm showing you right now, it is possibly an indication of smaller time frames dominating the market. And if you see consistent absorption in the form of higher highs and higher lows with decreasing volatility, odds are greater that you are dealing with the real support. Now I want to show you an example from the gold market from January 2016. This example shows how the really good breakout momentum trade occurs in the market. Well, first of all, we see that the market was going sideways for a while. It was pretty long consolidation area. And then notice what has happened at the beginning of February. Market was showing higher highs and higher lows. We see the small consolidation area, right? And what is more important, we see elongation. So if you try to build an angle between impulse and the correction, you get angle more than 90 degrees. So it is an elongation. Also, if you build an angle here, you get an obtuse angle. And that is a hidden sign of strength. That is a sign of absorption. That is a typical setup. You see the trading range, the small trading range is building at the top of the big trading range, and eventually you see even smaller trading range with very low volatility, and that is a signal for entry. When you see the setup, it is a pretty strong signal for entry. And the second example that I want to show you here is from Euro versus American dollar. It is February 2016, and now we are dealing with descending trend. You see that highs and lows are going down. We see signs of descending trend. And also we see elongation. So first of all, you see a trading range or a trading channel with minor decline to the downside. But if you see the level or two lows from February 18th and February 19th, and if you try to build an angle between impulse and the correction, you get the idea that you have 90 degrees angle or possibly even the obtuse angle between these two lines. It is consistent absorption of demand. Every time market tries to rise, it experiences pressure from the upside. So when you look at the market at February 22nd at the beginning of the day, you see that ATR or historical volatility for the period of 2 weeks is the lowest. So possibly the market is ready to the breakout. How do we play the breakout trade here? Well, notice that volatility has become very low, not at the bottom of this trading range, but in the center of this trading range. So we have to use smaller trading range, this very small trading range, to establish a breakout momentum trade. So our entry point should be here at the beginning of the day, possibly before the European trading session. Also, we see that market is unable to reach the level, the rotational center. It is also a sign of weakness, sign of readiness to break out to the downside. So our level that we are using for establishing a short trade, breakout momentum trade, is here. So that is our level. We can set our stop loss using ATR, multiplying it by 1.5 or using it as it is. ATR is very low here. Notice that the value of ATR is 13 pips. So we can multiply it by 1.5 and get stop loss equal to 20 pips. And if we enter a position at this point, we have our stop loss equal to 20 pips. And we just hold a position until the day ends, or even using the period of 2 to 3 days. And also I want you to pay attention at the chart of American dollar versus Canadian dollar. It is also February 2016. Notice that we had a low established in February. If you try to measure angle between impulse and the correction, you get the idea of obtuse angle. Well, maybe it is not very good to build an angle this way, because we had high here and we had high here. But even if we use this high, we also get the angle equal to 90 degrees or even more. Well, this setup is not very easy to recognize because you don't have reduced volatility here. We have sort of a rotation. Trading range is not very narrow like it is shown here. Instead, market just breaks to the downside. I'm not sure that it is very easy to capture the breakout momentum trade here. At least I haven't done that because this trading range is not very narrow. So market is not showing us the preparation for the breakout. It shows us the elongation, it shows us the angle between impulse and the correction, but it doesn't show us the preparation for the breakout. So you can easily skip this trade and you see the market breaking out just after this event. What I'm going to say that it is normal not to see a setup in some cases, because market not always shows you good entry points like it is shown here. Well, our goal as traders is to find best opportunities to stack the odds in our favor. Sometimes market just goes, it just breaks, and we are not capitalizing on this opportunity. What about this kind of setup? It is American dollar versus Swiss franc, and you can also build angle between impulse and correction to recognize that it is equal to 90 degrees or so. And this is also a sign of absorption. But what happens next? We see that market just breaks the higher level without stopping here, without forming an intermediary trading range. So it just goes. I call it extension. When you see an extension, sign of strength is gone. It is no longer a good setup. So if you see an extension, well, that's no longer a good situation. Well, after that also you see a small elongation here, and possibly you can capture something here, but it is not really a good trade because profit-loss ratio here is not very good. Well, if you would see that the market is consolidating at the top with a decreased volatility, you would say that, well, wait a minute, this market is forming a sign of absorption. But it hasn't happened here on this chart. Otherwise you could set a buy stop order here and go with the trend, go with the breakout. Let's go once again through signs of absorption, through signs of support that we can use for establishing a breakout momentum trade. First of all, you see dynamic market, rising highs, rising lows, and you see correction that is visible. You see visible low with a right-handed skewing. So if you measure angle between impulse and correction, it would be more than 90 degrees or possibly equal to 90 degrees. Then you see market coming to the edge of the price action, coming to the current extreme, and volatility goes down here. You see the reduced volatility. It sort of tests higher levels, it validates higher levels. You see no pressure, you see no supply, you see no sellers pushing the market down. The market is consolidating at the top, and eventually you can set a buy stop order and go with the breakout. If market just goes through a level and establishes a new high, it is just an extension. It is not a setup, it is just an extension. So you need to see consolidation at the top. It is a sign that a market is preparing for the breakout, because all preparation for the breakout was visible before. You may recognize that such setups are not too frequent in the market, and most of the time market generates sideways action, and you also have to know how to work in a sideways market. And the question is, can we initiate breakout momentum trade within a sideways market? Well, my answer on this question is yes, you can also initiate breakout momentum trades within a sideways market, like it is shown here. First of all, you identify what I call the rotational center, and of course it might generate false breaks several times, and after that it eventually generates genuine breakout with increased volatility. It is your opportunity to establish a trade with pretty small stop and gain nice profit-loss ratio, closing your position once market achieves previous extreme or the higher border of the trading range. Now let's get back to the example of gold. And after market has initiated the culmination or the big trending day with acceleration, it was February 11th, I call such days culmination. And also control is changed after such a day's volatility is increasing. So we also want to earn something inside of the range, because we know that market will correct, the volatility will increase, market possibly will correct. So our challenge is to identify trading range within this trading range and initiate a breakout momentum trade using this level. How do I identify the rotational center? It is the point where market finds balance. And the first observation is sequence of doji bars, so doji candlesticks with very small volatility, like it is shown here, for example. Well, it is not the only observation, because market has to validate this level. It has to show you corrections, it has to show you tests. It will show you that this level is genuine, that market gets back to this level, and it's not going away from this level, because if you see reduced volatility but market eventually settles at some levels below, well, it is not a trading range that we want to work inside. This is a trading range that is good for our trades. So that is a level, right? It is 1209.11. What happens after that? You also might want to generate a breakout beyond this level, but you see that several times market is unable to get out of this level. And to filter excessive activity, you need to wait for a while. You don't need to be very active here. If your attempt was not successful, wait for the next day and try to establish a trade. And eventually market has emerged from this trading range only after February 18th. It is a validation. You see also here, also market shows you very reduced volatility. And eventually, if you put up a trade here, you can generate nice move to the upside. How do we place our stop using such levels? Well, our stop has to be pretty small, because we don't want to have extended stops. We can use ATR to place our stops or any other method. Sometimes if you have a bar or a candlestick closing above this level, you can use it as a benchmark for your stop. For example, you can place your stop below the low of this candlestick. This time you can just use ATR. Here is a breakout momentum trade. Notice what happens after that. Market gets back to the rotational center. You can even try to re-enter the trade at the very next day, at the February 22nd. Eventually market emerges from this level once again at February 23rd. Well, you might not capture this trade because it is late in the evening or very early in the morning. It is Asian session, but eventually market starts from this level and ends up at previous extreme. And here is another example from British pound versus American dollar. It is from my Twitter that I share for traders of my educational group. Here is the rotational center, and you see that market tries to break out the rotational center, and this breakout is not going to continue, and the breakout continues only on the day after that. Let me show you the example from the market. Here it is. Here is the entry point. 1.4511 or so is a rotational center. Also, market is unable to generate meaningful move at this day, but at least for the day trade is pretty good profit loss ratio. You can close your position after getting 3-to-1 profit loss ratio. Eventually market breaks out this level, and after the small test it goes and it generates meaningful move to the downside. How do I identify the rotational center here, 1.4511? Well, if we look at the chart, we may notice that we have a couple of clues here helping us to identify the rotational center. First of all, it is reduced volatility. It is a sign of balance. Then market validates this level with the pullback, and couple of pullbacks are visible here. Also, market shows us signs of weakness. It is unable to reach extreme of the previous day early in the day of February 11th. So I am prepared to go against this move. I'm prepared to set a sell stop order below the level 1.4511. Don't get me wrong, you see that there are plenty of false breaks here. For example, you see the false break here. Well, this break is pretty nice, right? But also you see the false break here, and etc. And when you initiate a breakout momentum trade, you will be stopped out very quickly, but it is a go no go level. You know pretty quickly that you are not right, and you get rid of your position very quickly. So, for example, if you have a level, you set a sell stop order, you get inside a position, you are stopped out very quickly, then you wait for a while or wait even for the next day. You set a stop loss order, you set a sell stop order, then you're stopped out from your position also very quickly. Your equity curve will look like it is going down, but it is going down very slowly. And when you capture a trade with a profit, it will move your account forward. Now let's go through some numbers. Here you see the equity curve of 1 month of previous year when I was employing breakout momentum strategy on my account. You see that 2 weeks or maybe more I was not generating any profit. I was fighting with zero. I call it fighting with zero. So I was keeping my capital, I was managing risk, and profit was made only after August 20th or August 22nd. It is the 3rd or even the 4th week of August of the whole month. Then eventually this month was closed with a profit. Here you see distribution of winning versus losing days. And you see that I had only 4 really good winning days here. Well, 2 last days, September 1st and September 2nd, was so-so. This is not a big deal. But at August 28th and August 21st, I had generated pretty big moves. I had generated pretty nice profit that had turned my trading around this month, and eventually I had generated positive result for the whole month. The majority of activity within this month was just trial and error. I earn some, I lose some, I earn some, I lose some. I keep my capital in the game, I try to enter a position, I try to get inside a good trade, and eventually I get inside of this trade. And even 2 trades. That is how it works. It is not a holy grail, nothing magic here, it is hard work. You see that there is nothing fancy in trying to get inside a good trade. You keep your capital in the game, and it is pretty tough psychologically sometimes when you don't see any profit, when you generate sideways action of your equity curve, only to see that you are stopped out several times, then you earn some, then you again are stopped out. Not too many traders are okay with this trading style. Not too many traders want to see such sideways action of their equity curve. Well, but I would say to you that this trading style may be not very comfortable, but when you know your risk, when you know very quickly if you are right or not, when you live without any position, when you just enter your trade and you know after 1 or 2 hours that you are not right, you get rid of your position, you cut your loss, and you proceed with a new setup. It is a form of psychological comfort as well. That's why I like this trading style. I prefer to know quickly whether I'm right or not. How does the best trading day look like when you trade the breakout momentum strategy? You enter your position, you experience very small drawdown because your stop also is very small. And when the market breaks, you just hold this position until the day ends, and you just see the profit. You keep the profitable trade. You are not getting rid of your position very quickly. You let your profit run. It is the profile of the best trading day, or maybe the typical best trading day that you can see using momentum trading strategy. And before we finish our webinar, I want to say a few words about managing equity curve. What do I mean by that? You might remember that if you accept stop losses and wait for the big day or the big profit, you might experience drawdowns or sideways action of your equity curve. Instead, you might want to have smoother equity curve, and to achieve this goal you might split your target into pieces. For example, you can set several targets instead of trying to capture one big target. You may subtract 50% or 30% of your position once price reaches the first target. So you will manage risk without being forced to set the stop loss to break even, which is not very effective action, because in many cases price retests your entry point, and if you set your stop loss to break even, you will be thrown out from your position. You will not earn anything. Also, you will not have to have trailing stop. Doing so, I mean fixing partially on the first target and partially on the second target, you are acting as a day trader on the one hand, capturing small profits, and as a swing trader on the other hand, capturing bigger profits. So when market is not generating any meaningful moves, nevertheless you can earn something and make your equity curve looking smoother. Well, there is no free lunch in the market. If you fix your profit partially, you also are not able to get the big swings and capitalize on them. So you will not expect to have large days or big days like I was showing you in the statement. But psychologically, fixing your profit partially may be better than waiting for the big action. With that, we are going to finish our webinar. I hope it was useful and you have got clear vision of momentum trading strategy. If you have any questions, feel free to leave them below this video and I will do my best to answer all of your questions. Manage risk and trade responsibly. See you in the next video.